that's going to be the vast majority of these loans that are going to come due. But there's plenty of others, Matt, that are going to be in a world of pain. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, as always on these Wednesdays, we got Matt Jones. Matt, how are you doing today?
I'm doing fantastic. How about you, Todd?
I am doing good, man. It's done raining, so we're good. Rain in January in Minnesota is just not that cool.
No, everything turns to mush and then freezes, and
yeah. At least it didn't get to like 30 below last night. Like usually that's what it does, but now we're all good. So, man, just trying to rock out the new year. We're working on a couple deals. We might even get a deal purchased this year, so we'll see. We're working pretty hard. We've got some progress. We'll see what happens. Of course, I'd never count a deal as a closed transaction until it's closed. So, but we've got some exciting stuff in the works. We've got a property we're looking to sell as well. Or that one's one without investors. So, but we're looking to potentially sell that one. We do have it under contract. So again, never count a property closed until it's closed. So we'll see what happens. I think there's still plenty of opportunity for it to not close. But we'll see. So it's an exciting start of 2023. I always hate to have a year start out slow, and we're starting off right so far.
Excellent. Yeah, I mean, I expect the year to be interesting, maybe weird, but granted, the past few years, everyone has been interesting and weird. So more par for the course, I suppose.
Yeah, par for the course. I mean, when was the last time a year hasn't been weird or unexpected, right? I mean, yeah, it just happens every time. We could go through the list of year over year over year where, whatever is expected to happen, it doesn't happen. So no matter what we say, it seems like if something different happens, but it doesn't mean that you shouldn't have, maybe predictions or I guess more or less just really awareness to understand things that could happen. I think it's always really important to have your own kind of thesis and just thoughts about what's going on and how you can prepare yourself for potential opportunities that are ahead, potential waves that might come crashing in, all that kind of stuff. And knowing that a lot of times it might not happen, right? I remember I think it was 2018 or maybe it was 2019. We all expected a recession to happen and it didn't happen. Well, it kind of did because COVID caused a very, very short-lived recession, but we all know what happened. We bounced back quickly. And so anyways, regardless, we're always expecting something to happen. A lot of times it doesn't, but it's just good to be prepared and be aware and understand what's happening in the markets around you.
Yeah, exactly. And none of us have a crystal ball to see exactly what the future will hold. But what do you expect, though, the biggest real estate challenges investors will face in 2023?
Yeah, so I think there's a couple things that should be on kind of everybody's radar. Obviously, interest rates are first and foremost. Interest rates have been climbing and are still climbing. Fed fund rate is climbing and still likely climbing. Most people are expecting a 25 basis point jump here in just a few weeks to be announced, or just like a week to be announced, and potentially see another 25 to 50 basis points on top of that throughout the year. And who knows, and maybe more, depends on what inflation data comes in at, I think. And the Fed really has this, hey, we want to get inflation back to 2%, and we're going to do everything we can to get inflation back down to 2%. And so I think they're just going to continue to push those buttons. So with that said, mortgage rates are at highest levels we've seen since the Great Recession, which quite frankly, they're still not that high. But they are, when you look back at history, Matt, you can say, oh, these rates are nothing, but you can't really compare these rates to history. You have to compare these rates to modern times. And so that's what we got to be looking at is I, I do agree when people say, well, these rates are nowhere near high. Look at back in, 2007, 6, look back in 1980s, 1990s. Well, okay, but that's not reality, right? How many people have a mortgage that's still around that was underwritten in 1980, 1985? When you look at what those interest rates we're comparing them to, nobody has a mortgage from them. They've refinanced, they've sold the property, they've paid the mortgage off, whatever it might be. They just don't have the mortgage from that time. So we're comparing mortgages from the last decade to today. And we're going, wow, these rates are really high. They've gone way, way up. And so that's reality. Pricing has been built in to these interest rates. Have been the lower interest rates. They've been around long enough.
Yeah, exactly. The comparable rates in the 1980s when interest rates were high. I mean, the purchase price was much lower then in dollar, from then to now, and so and other circumstances as well. So it's not equivocal.
No. Yep. Like I said, pricing's been priced into low interest rates, and so that's what we have. So certainly that's going to cause some disruption, Matt. I think there's going to be some opportunities to be had. There's a couple things, so a lot of almost 50% of new loans are floating rate loans in commercial real estate. So by floating rate, it doesn't necessarily mean bridge debt. It could be an agency debt, could be life companies, but it's floating rate. Okay. Meaning that rate is going to reset most of the time. That rate is based on, SOFR or something like that. Okay. So it's based on you're saying, hey, you're paying 3% over SOFR, you're paying 1%, whatever it might be, but you're paying a certain price over a specific rate. And every time the rates go up, your rate goes up. And so you're floating. So 50% of these are based on that. Now, a lot of lenders said, you can have this floating rate, but we're going to require you to buy a rate cap. Now, the rate cap's no big deal when the rate cap is cheap. And so you're able to buy the rate cap at a very affordable price. So maybe your rate cap costed you $50,000. Well, that same rate cap that maybe costed you $50,000, 3 years ago when you locked it in, and now it's resetting. All of a sudden, instead of $50,000, that's going to cost you $600,000 for that same rate cap to get the same deal as before. So either your rate cap's going to have to go up, your rate is going to have to go up drastically to get your rate cap dollar amount down, or you're going to have to spend that money. Okay. So that's definitely a big deal. The other thing is we've got, I believe it's $1 trillion worth of loans that are expiring in 2023 and into early part of 2024. So into the next year, over the next year. Now, a lot of those, and the vast majority, by the way, are going to be just fine, Matt. You bought a property in, 2015 or 2016, and you had it locked for 7 years. You're fine. No big deal, right? You've paid off a bunch of your principal. Sure, you locked it in for a better rate, but your cash flow's gone up a lot. Your basis is low. Like you're doing just fine. You might not be able to refinance it and pull out a bunch of money, but you're doing just fine. Sure, certainly your cash flow is going to get hurt a little bit, but if you've done good management, raised rents like you likely have, you're either going to sell the thing and take your profit, or you're just going to go, whatever. My cash flow is going to get hurt. We'll just refinance it in 2, 3, 4, 5 years when rates go down. No big deal. Okay. So that's going to be the vast majority of these loans that are going to come due, but there's plenty of others, Matt, that are going to be in a world of pain, or potentially. And so what I think is going to have to happen is there's going to be new equity that's going to have to float into the market. Now, it might be the current equity is going to bring more equity. So a capital call. Current equity is going to bring more equity into the deals. So sponsors are going to do capital calls. Private equity firms are going to do capital calls. People are going to be doing capital calls. And I think there's going to be a decent amount of that happening. But then you've got less experienced, syndicators, less experienced groups that just don't have the bandwidth to do a capital call, or they, maybe they stretched to get this deal in the first place. Let's call it a group of doctors. I don't know why I'm picking on doctors, but a group of doctors, and they bought this property and they had to put, $4 million down, and that they stretched to get that done. And now they got to bring another $1 million or $500,000 to the table. And like, crap, we don't have that money because we stretched already to get this deal done, So I think there's going to be some of that where new equity is going to come in and have to replace that. So that, for instance, that group of doctor is going to now have to reach out to their doctor friends or their buddies and say, hey, do you want to partner with us? We'll give you some equity. Just partner with us. And, we need 500K. So can you bring in 500K into this deal, or 2 or 3 people bring in 500K? And we'll give you 10% of the equity. And they're going to have to give something up. Or a syndication might say, dude, we can't come up with this money. What are we going to do? We got to get new money into this deal. We can't go to a capital call because our capital or our investors say no. And so then a group's going to come in. So I think there's opportunity for that. If you have a good network to be able to get into some other deals and bring new equity into these deals. Of course, there has to be enough meat on the deal in order for that to happen.
Yeah, exactly. And, speaking of loans as well, bridge loans have been pretty popular these past few years, but
those are the big loan that I'm talking about, Matt. I mean, though I think a lot of those are going to be the ones that are going to have some trouble.
But I hear that getting into new bridge loans is a little more tricky now.
100%. And it's riskier, right? Because we don't know where rates are going. The indication is that they're going to go up. How much are they going to go up? Your loan cap is your rate cap, is going to be really expensive. Like we already talked about, most bridge lenders are going to require you to buy one. And so you're spending, $1 million, let's call it, on a rate cap, or $500,000, whatever it might be. But you're going to spend a bunch of money on a rate cap. Your interest rate's going to be really high. You're going to have to get low leverage, no more 80% LTV, type of thing, or LTC, no more 80%. You're probably looking at like 60 to 70%. So unless you're a really, really well qualified buyer with a really solid business plan, but it's just much more difficult. And there's just a lot less money chasing those, especially the mid-sized deals. So 10 million and under, there's just a lot less money chasing those.
So since you have to put more money down into a purchase, their returns are naturally going to be less.
Well, so we've got something interesting, Matt. We've got what's called negative leverage, and negative leverage is really, we haven't seen that. And what that is, I should say we haven't seen it in a long time. What negative leverage is that your cap rate is lower than your interest rate. Okay. So when you're buying on a cap rate lower than your interest rate, that means every dollar of debt you put onto the property actually decreases your ROI. So the more leverage you put on, the worse your ROI ends up being. So actually purchasing with cash, with all cash, ends up yielding you the best. Now that's just in a straight transaction, Matt. Now that's not including a value add where you can increase the value and potentially then basically be repositioning you to a positive leverage debt. But if you're buying a property at a 4 cap or a 4.5 cap, and you're putting 5.5% interest rate, you've got negative leverage there. And that's something unique. Now it's not that you shouldn't do those deals. You just have to be aware of what you're doing on those deals and make sure you're setting yourself up the right way. And a value add can be the right way to do it. Potentially, you got to be careful.
Yeah. I mean, it depends on what your, business plan is, what your goals are and stuff.
Yeah. But you're right. I mean, overall general leverage is less. And so your potential returns based on that leverage is definitely going to be less. And so being able to get look, the market was behaving extremely well. And so if you bought something and sold it between, or bought something and sold it in 2022 or before, you likely were able to get a minimum of a 15 IRR all the way up into the 20s and maybe even 30s, or potentially more, depending on exactly what happened and what market you're in. But a lot of deals were making investors 20% IRR returns, which is really dang attractive. And I don't think that's going to continue, or I shouldn't say it's not going to continue, but it's going to be a lot more challenging right now, at least to project it. Certainly could it happen, but man, I have a tough time thinking we can be projecting much rent growth. We have to certainly project inflationary growth on the expense side. And we have to do low leverage debt. So we're looking at, 60, 65% LTV, most deals.
And when there's minimal rent growth, the way to add, easy way to add value is to decrease expenses whenever possible.
Right. Yeah. Yeah, man. So that's kind of a little bit on the real estate side. I think rents, when we talk about rents, I think rents, depending on the markets you're in, are going to be lower. Now, there's going to be some markets certainly that are going to see nice rent growth. I mean, the markets I'm in are projected to see pretty handsome rent growth still in 2023. I mean, all the markets I've been are seeing 5% plus rent growth right now and are expected to continue to see that. But there's other markets that are seeing negative rent growth, Phoenix, Arizona, Las Vegas. We already talked about those, Sacramento. Those three ended the year as a negative. Sacramento was negative 3%. Las Vegas and Phoenix were negative 2%. Minneapolis, the market we're in, was 0.4%. So they ended up with a positive 0.4%. But what's interesting is we actually have to dive in even deeper. And we can say Phoenix, Arizona went negative 2%, but what did the submarkets do? Now, I don't have those statistics, but Minneapolis, I do. Minneapolis ended up at 0.4% rent growth. St. Paul was at 0.3% rent growth. However, some submarkets, most suburbs ended up much, much better. And so depending on the suburb you're in, you ranged anywhere from 2% all the way up to 8% in the Twin Cities. The only submarket that I saw with worse than Minneapolis, St. Paul, interestingly enough, is a very good submarket, Woodbury. And the only reason why is because they had a large amount of building that took place. So it's very submarket dependent. And I would imagine the same story is to be said in Phoenix, the same stories is to be said in Austin, Texas, that saw pretty poor rent growth in 2022. And especially now they're seeing a big negative rent growth, and that trend is looking like it'll probably continue. So I think 2023 overall, we're going to see pretty slow rent growth. I think there's going to be a decent amount of markets, and quite frankly, I think they're going to be mostly in the Sun Belt that are going to see negative rent growth in 2023. I know that's contradictory. I know that most people probably will disagree with me, but those markets have had such big run-ups that I think they are poised for a downturn. However, I do think most of these markets that are going to see the negatives are probably going to be the strongest markets into the future. They just are going to see a year or two of negative rent growth, and you got to be careful in those markets.
Yeah, I mean, real estate is a long-term thing. You can't just plan on it being for the short term only.
Yeah.
So I am expecting prices to come down a bit. They've started to come back a little bit. I expect them to come back. Granted, I don't know exactly what that is going to look like. But if you're buying, you're going to want to negotiate a little more. If you're selling, you want to do your best to get as much price as you can.
Yeah, it'll be interesting to see what happens with pricing. I agree with you. I think that pricing will continue to come down. It already has come down quite a bit. But I would consider that it's going to continue to come down maybe another 10 to 20%, depending on your market you're in, and maybe more, maybe less. But I think that's going to continue to come down. And I think a lot of it's going to depend on how sticky these interest rates are. If the Fed, goes up 25 basis points or 50 basis points right now and continues, and that stays through, especially if it stays through the summer and all the way through 2023, I think definitely we're going to see these prices drop. I think right now, a lot of owners are expecting this to go down, expecting rates to go down. And so they're holding on because they think, hey, if rates go down, my price is going to go up, which they're 100% accurate. And so I think a lot of potential sellers are just holding on. I think the other thing that's going to affect pricing, Matt, is just how much distress are we going to see? How many owners absolutely have to sell? How many of these owners that, out of the 50% that have loans, that are floating rate, how many of those have to sell? How many of the $1 trillion worth of loans coming due are going to have to sell? I think a lot depends on the have to versus the I'd like to.
Yeah. And I'm also anticipating raising capital to get a little trickier this year as well.
100%. Yeah. Raising capital will definitely be more difficult. It's always going to be fairly easy to raise from investors that can write $1 million plus check. They're going to still be out there. They understand that this is an opportunity. But I think that those that are writing $50,000 checks or $100,000 checks, they get nervous quicker and they respond to opportunity slower. In general, of course, there's some very sophisticated $50,000 to $100,000 investors that understand the opportunities and are going to invest. But for the most part, I think that generally, let's say that's your entire network base. You're probably going to lose. I don't know what the statistic is. I guess I'll find out because that is my network base. But probably going to lose 50%. We're counting on 50% or more. Not lose, but temporary hold, right?
Yeah, I know this inverse of the market. When prices are high, it's easy to get money. When prices are low, it's harder to get money.
Yep.
So after all these years of your own investing, what are some challenges that have continued to plague you, even now?
Yeah. So, I mean, there's a couple things. I'd say first, it's on that money and the deal side. We're always at a fight in that relationship. We're either finding too many deals and don't have enough money, or have too much money and not enough deals. And we've had too much money and not enough deals. But again, if that changes, if the market softens, we're probably going to have too many deals, not enough money. And so we're always fighting that. We're always looking for more investors. I think the money side is the one I can control more, right? Building more relationships, talking with more investors, improving our track record, all that kind of stuff. The deal side, certainly we can improve upon as well by building those relationships and getting the deals. But that's also a little bit, I guess both of them are a little bit dependent on the market, right? So we're doing everything we can to build both of those up. I think one thing that I have struggled with, and now bringing my business partners in has really helped. I have struggled with the systems and the organizational aspects. I love organization. I love systems. I think they're so important, but my brain says, I got to get some systems and processes and things in place. And then 7 years later, I'm like, I got to get those systems and processes and things in place I talked about 7 years ago. So having, especially Matt, my my business partner, Matt, I mean, that's just his thing and he loves it. He's good at it. And so he puts those things together and it's like, dude, this is amazing. It helps me stay so much more organized. So I think, for me, having that on my side has been just instrumental. And I wouldn't say I'm not this like super disorganized guy, but I thrive on having systems. I also thrive on chaos, but there's got to be some like, I don't know how to put it, but chaos can't just be chaos, right? It has to be some organization to your chaos. And so having, Matt organizing my chaos, and so it's actually in a place, has been instrumental. So, but I still struggle with that. But I think that's just who I am. I have to have a certain amount of chaos in my life.
Yeah, I mean, in a sense, though, like having some chaos, even with ADHD, that can be to your advantage too. So, to be able to like focus on different things and switch roles and tasks and things. So,
Yeah, and that's definitely a struggle. I've said it before. Like I've never been tested for ADHD, but zero chance I don't. I mean, I have it. I'm totally ADHD. I mean, before my wife would joke around with me as when she was my girlfriend, like she called me ADHD boy all the time. But for me, it's like I can allow myself to get really distracted if I don't have some of that organization. So that's always things I'm trying to, okay, how do I work on that? And I've done implemented a lot of things to kind of keep my brain on task, and always just continue to struggle with it though. And it's just always a work in progress, I think. Trying to think if there's anything else in the business that, we're kind of, or what I'm still struggling on today. But I think those are kind of the main, probably the main things. Certainly there's definitely other things. We're always trying to improve. We're always trying to be better than what we were the day before. I mean, that's really important. We're always not taking for granted what we've achieved and assuming that what we've achieved is somehow going to continue without our continuous effort, right? In improvement. And so I think that's really valuable, that we don't take for granted that we've achieved something in the past, what's going to come to us in the future. It's continual hard work. And then even with these acquisitions and, yeah, we've built this company and it's there, but we can't take for granted that everything's going to work perfectly. So we have to make sure that we're continuing to push forward, continue to challenge ourselves to improve ourselves, and continue to just try to be the best we can be at what we're doing.
Very good.
The other thing I would say, Matt, for me is like, I've worked on this a lot over the last several years, and I've worked on this a lot for like the last decade plus, but I'm good at a lot of things. And if you become good at a lot of things, you start to become not good at anything. And so I've really tried to focus on the things that I'm really passionate about and that I feel like I'm maybe the best at. And some of the things that I maybe focus on, I'm maybe not the best at, but I'm becoming the best at. But that's what I really, really enjoy doing. Right. And so that's something that I've really, and Endurance in general. And so we've just really tried to focus on what our roles are. And it's so easy because I've done everything in real estate, right? I've been the only person on the GP side. And so I'm finding the deal, I'm underwriting the deal, I'm getting the investors, I'm getting the loan, I'm doing the whole thing, asset manager, everything. And so it's easy to like try to be this control freak. But man, you're going to go so much faster, so much farther faster if you're not a control freak and you allow yourself to give some of those other things up. And so that's definitely something I continue to struggle with, and just are trying to improve upon and just be the best at just one or two areas versus be good at everything. So.
Yeah, I agree. The more you can niche down in real estate and become the best at that, the more value you can add to other people at the same
Yeah.
time, and more money you can make.
Yeah. Matt, how about you? What are you still struggling with today? Yeah. What are you working on?
The thing that I'm working on most is increasing my capital raising skills. So, I'm going to a conference in Kentucky specifically on that. I've raised a little bit of capital so far, so I know I can do it, but it's just a matter of getting those systems in place and building my network more. So that's really my big focus of 2023 is, building my network of people who I can help to passively invest into real estate.
Yep. I think one of the things that a lot of people focus on when they're capital raising is their systems. I don't think that's important. I mean, certainly it's valuable, but it's definitely not that important to have systems in place when you're trying to grow your investor database. Now, again, that's not entirely accurate because you do want a way a CRM, you do want a way to track your contacts, and you do want a way to communicate with your contacts. But I think too many people worry too much about all the bells and whistles and systems and trying to get everything perfect and not think about how am I actually connecting with investors? How am I actually raising capital from them? How am I providing value to them? How am I communicating with them? Like that, I have to have investors in order to need the systems. Right. So that's something that I think a lot of people, especially analytical people, want to get all the puzzle pieces in place, and they focus so much on that. They spend a lot of time and energy on that, but they forget to spend the time and energy on the relationships. And that's what capital raising is all about. It's all about the relationships. It's all about getting people to know, like, and trust you, to want to take advantage of the opportunities you're putting in front of them because they see that as an opportunity.
And the other thing I'm working on is consistency of my efforts. I can work really hard and like make a big push, but then, I lose steam and then I got to get going again. And then, make another big push to make progress. So, instead of making these, spurts and bouts, just keep on chugging away consistently
Yeah.
throughout.
Yeah. Love it. Love it. That's, yeah. So easy to do what you just said. So cool. Awesome, man. I don't have anything else. How about you?
Nothing else. I'm just looking forward to a great year.
Sweet. Well, Matt, you have a fantastic rest of the day. Make every day Saturday.
Thanks. You too.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. But your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.